Join our webinar tonight. Tonight we are going to talk about financing and investment property, and we have a lot of information to cover. I promise I'll keep this as short as possible. I promise this won't be any longer than 30 minutes. You know, when you do these things and you practice them and you test them, the timing on it is always really short, and then when I get in and actually do them, the timing goes quite a bit longer. So if you guys have any questions, feel free to type them in the chat box. I'll get to as many questions as I can towards the end, but I will save those to the end. Okay, so I'm going to get started right now. All right, let's see. Give me a second. All right, guys, we're going to talk a little bit about interest rates and the history of the market right now. And so we're going to start just by talking about where we've been, where we are, and theoretically where we're going here. I'm going to start just talking about the history of interest rates. I have a chart here that shows you the average rate over the last 50 years of rates. Today's rate is this is actually perfect. So 5.875 is today's rate. Today's rate for an investment purchase through Fannie Mae. So I did some calculations before we started this so I can get real accurate today's pricing. And interest rates today, if you want a Fannie Mae loan and you're putting 20% down on an investment purchase, your interest rate with Fannie Mae today is 6.99%. That is the rate today. And so, you know, we've all been warped in our thoughts and theories of all the interest rates being 3 and 4%, which, you know, was nice the last few years. But the reality of that is things are adjusting back to a normal market right now. And so this shows you where rates have been and theoretically where rates are going. Our trajectory right now is interest rates are going up. The Feds have announced that at the end of this month, the 26th or 27th Fed meeting, they intend to push interest rates up again. And just to put this into perspective, we have moved the largest amount in interest rates in the shortest amount of time since we've been tracking since the 80s. And so interest rates have moved up a full 3 points since January 1st of the beginning of this year, which again is the largest amount in the shortest period of time that we've moved interest rates. All right. All right, recession doesn't equal a housing crisis. This is a great chart because typically people think whenever they hear the word recession, that means housing prices are plummeting, okay? This chart shows you, obviously in 2008, we're all very familiar of where housing prices plummeted, you know, a huge swath of value over that time. Housing prices from 2020 forward have been going up. So California is kind of a silver lining to the rest of the country. California properties have gained an average of 18% the last 2 consecutive years in equity. This one, again, this is going national with these types of numbers on here. And so really where I wanted to point out with here is just because you hear the word recession, that doesn't necessarily mean housing prices are dropping. People ask me a lot of questions about how does this time period compare to 2008? And I'll tell you a couple things. First and foremost, in 2008, we had a ton of inventory. Right now, we have absolutely no inventory. We are extremely minimal on what we have available. The second thing is people got a ton of equity right now. So, you know, back then, people were encouraged to sell because people were looking to buy bigger houses, get more stuff. Right now, people are sitting on so much equity that we're not necessarily in any kind of position where we were before, where everyone was putting no money down. They had no equity in the house, so they were happy to walk away from that because it was, you know, essentially theoretically no harm, no foul. And so we are not anywhere near where like we were in 2006 and 2008. So we have a ton of equity right now, and we have a lot of products that enable people to tap some of that equity, and that's some of the stuff we'll talk about here shortly. All right, let's talk about market shifts. So this market has significantly shifted from a seller's market to a buyer's market really in the last 6 weeks. This shows us a chart of how much inventory we have available from May of this year versus May of last year. And you can see the inventory has literally doubled from what we have today versus a year ago. Now, nationally, on a national level, last month we added 110,000 units of inventory to house sales. That still, which sounds like a lot, that still puts us at the 50% mark of a normal market right now. So we're still 50% below a normal market of how many availability of listings should be available right now. And obviously summertime is the buying season. So this is when the most products or the most houses are available. And so that goes to show you right now that still, we are still in a very, very, very low inventory situation. High demand, low inventory, true economics, okay? All right, I just throw this on here real quick because I want to show you guys the cost of waiting to buy a house. This is a client who I had worked with back in December, got them pre-approved. They were buying a primary house for themselves. They have been pre-approved for a $650,000 purchase price with a rate of 2.875, monthly payment $35.50. That's with taxes and insurance. I pre-approved them again at the beginning of last month. Last month they were pre-approved for $550,000, 5.875 rate, $37.50 monthly payment. So within the course, let's say of 6 months, same everything, same income, same credit score, same everything. They are now qualified for $100,000 less with a monthly payment of $200 more. Okay, and that's specifically because of the shift in interest rates and where it goes. So this shows you the cost of waiting to buy a home, how much more expensive it'll cost you by waiting. This just kind of breaks down over a 30-year term of a loan. You would pay an additional, unfortunately, $300,000 in interest over the 2.75 versus the 5.875 rate. Okay. All right, home ownership against hedge inflation. Again, I just want to show you guys how right now, even though I know inflation is really high, I know gas prices are killing us right now. The cost of going to the stores is just absolutely crazy. And this shows you that even during inflation, in high inflation periods, our property equitable positions are still highly outpacing what the inflation rates are doing right now. Okay, so again, just putting this all into perspective. All right, let's get into the nitty gritty here. So what we're talking about tonight is how to buy an investment property. Okay, I'm going to give you guys some real generic vanilla terms of essentially what we start with, a Fannie Freddie kind of product, and then we'll move into some other types of products. Okay, so a qualified investor. What a qualified investor means with Fannie Freddie Mac, it means a couple things. First of all, you own a house already, okay? To buy an investment property, 99% of the time, unless I'm using private money or something like that, you typically have to own a primary house if you want to buy an investment property, okay? That is just an old traditional rule, and the reason is this, is that there's a lot more things that can be used to manipulate income and things like that on investment purchases versus primary purchases. Investment purchases are a higher risk. And so lenders typically want to make sure that you have the experience of having a mortgage, paying it on time, understanding the upkeep of a property, understanding you have to pay taxes multiple times a year, things of that nature. So qualified investor typically owns a house already. Minimum credit score is going to be 620. So 620 FICO score, again, for anything non-private money. Foreign nationals are okay. I'm going to talk about what reserves are, and reserves are required for any kind of investment purchase unless it's private money, okay? So we'll talk about reserves in a minute. Qualified investors had no BKs, foreclosures, or short sales. I put in the last 24 months, but really a qualified investor, you cannot have had a foreclosure in the past 7 years or a short sale in the past 5 years. So it gets real stringent on stuff with a qualified investor, okay? And qualified investment loans are going to be like a Fannie, Freddie, standard 30, 15-year fix. And again, we'll talk about those products shortly, okay? I'm going to talk to you guys about what reserves are. Now, reserves, whenever you purchase an investment property, the most important thing, obviously besides income and credit score, they're going to ask you to provide reserves, okay? Reserves essentially tell us that you have the ability to pay your mortgages or mortgage if you lose your job. And that's what reserves are designed to do. Typically, a lender is going to ask you about 6 months reserves per property. So if you own, let's say, 3 properties, they're going to make sure that after you have your down payment and your closing costs, you have enough money to make the principal, interest, taxes, and insurance payment for each property each month times 6. So if one of your rental properties or even your primary property has a principal, interest, taxes, and insurance payment of $2,890 a month, we're going to times that times 6. So just reserves of the one property you own is $17,340, again, on top of your down payment and your closing costs. Now, if you own 3 properties, times this times 3. So you're going to have to have another $51,000 in liquidable cash on top of your down payment and your closing costs. That's what reserves are called, and that's what reserves are. Now, the reserve, typically the 6-month reserve requirement is this. Fannie, Freddie, and some of these non-QM lenders are going to say that if you lose your job, you have the ability to access funds and pay your mortgage for at least 6 months. The theory behind that is within a 6-month time period, you should be able to find a new job. So you could solidify and still hold on to your mortgages and make all your payments and still potentially go out and get another job. So that's what reserves are. And when we're talking about if you're purchasing a jumbo investment property, you have to have 18 months of reserves on a jumbo investment property. So do the math of your mortgage payment with principal, interest, taxes, and insurance and times that by 18. That is, again, on top of your down payment and your closing costs, okay? They want to make sure, again, that you have liquidable cash. All right, I'm going to go over some loan lingo real quick because a lot of these things I talk about, I use in loan terms, which isn't always the most conducive to you guys understanding what the hell I'm talking about. And so some simple things, SFR, single family residence, PITI, this is something I'm going to use a lot. This is principal, interest, taxes, and insurance. It's like your whole payment is what the PITI means, okay? DTI, I'm sure a lot of you guys have heard that before, debt to income ratio, LTV, loan to value. I'm going to talk about BKs, which is a bankruptcy. DSCR, I'm going to talk about this here. I'm going to just touch on this real quick. What DSCR means, and we're going to talk about the product here shortly. DSCR means that you have a mortgage payment, principal, interest, taxes, and insurance, and you have a lease. The lease is the coverage that has to coverage the debt, okay? And so if you have potential or current lease or a potential lease that's going to cover the entire payment, that is all that's utilized to qualify for a DSCR loan, and we'll talk about those shortly. Non-QM loan, a non-qualified mortgage, and some of these products we're going to talk about shortly are non-qualified mortgage, and I'll talk about what that means. And then rental income. I'm going to talk about rental income in a couple different facets here. If you own rental properties and you come in to do a loan and you want to show me how much rental income you've made, we will go off the last 2 years, excuse me, of your Schedule E on your tax returns, okay? So we are going to ask for your last 2 years of tax returns. We're going to specifically go off the Schedule E. So if you tell me that you collect, I make $5,000 a month on my rental, awesome. When I look at your Schedule E, that should show me that. Now, a lot of times what happens is people collect all this rent, but then they have all these write-offs that go against the rent. So on their taxes, even though they think they're collecting $5,000 a month, their taxes might actually show me a negative of, say, $10,000 last year. Now, again, we take an average of that. So if you have a $10,000 all of last year, we're going to divide it by 12 months, and we're going to hit you with that negative every single month on your rental income for last year's taxes. Okay, and so there's some different things I can advise you guys and coach you guys on how we can get around some of those things. Okay. Technical error. All right. So we are going to go into products now. This is a traditional product. Okay, so a traditional product would be a Fannie Mae, Freddie Mac type of product. Now, I'm sure a lot of you are aware that we had a huge mortgage meltdown starting in 2008. Well, a lot of these things that came out of, 2006. Now, a lot of these things that came out of that foreclosure process was a lot of new lending laws. Part of it was the SAFE Act. Part of it was Regulation Z. What these things do is they protect you guys as the consumers, what they really do. And so Fannie Mae came out with something the last couple of years deemed what's called a qualified mortgage. And so when I do a loan for you through Freddie or Fannie, those are called qualified mortgages. And those hit a couple specific things. The most important thing of a qualified mortgage is we're going to verify that you have the ability to repay the loan. Seems kind of smart. So we're going to check your income documentation. If you're self-employed, we're going to ask for your last 2 years of personal and business taxes. We're going to ask for a P&L year to date. And then we may need a CPA letter. We may need something to verify that the income that you guys showed us last 2 years is still accurate with your self-employed business. If you are Joe Schmo and you have a W-2 job, we're going to look at your last 2 years tax returns, and we're going to make sure that for whatever your purchase is on this investment, the debt to income ratio cannot go over 43%, which is extremely conservative, okay? So again, to be deemed a qualified mortgage, can't have a DTI over 43%. With an investment purchase, it'd be 20% down for a single unit, or for a multi-unit, you'd be a minimum of 25% down, 2 to 4 units. Now, here's where the catch comes in with QM products, with quality mortgages. Okay, so if you've had a foreclosure in the last 7 years, you have to wait till you're 7 years and a day from that discharge date before you can do a Fannie Mae or Freddie Mac investment purchase. 7 years from the foreclosure date. Okay, which is a very long time. And so I have some other products we're going to talk about that kind of shorten those periods a little bit. Okay. Fannie Mae product requires a typical 620 credit score. Obviously, you guys understand as consumers, the higher the interest rate, the lower the credit. The higher the credit score, the lower the interest rate, and vice versa. Lower the credit score, higher the interest rate. So 620 is the minimum. Obviously, 800 would be the maximum on that. All right, so let's talk about some non-QM products. So again, if you want to buy an investment purchase through me through a Fannie Freddie product, you would need at least 20% down for a single family unit or 25% down to 2 to 4 units, okay? If you do not have any rental, if you do not have any investment history of purchasing investment properties, we will allow you to use a percentage of the potential rents on that property, up to 75% of those potential rents, okay? And that can obviously help you guys qualify for more of a purchase price. So if you're looking for something 2, 3, and 4 units, understand obviously the additional rental income on that will help you as a consumer qualify for more of a purchase price because your income gets added to the additional rental income that's going to come onto this property, okay? So again, there are some real benefits to purchasing multi-unit versus single unit, specifically for qualifying aspects as a consumer. All right, DSCR loan. This has been the most popular investment loan that we have done in the last couple of years. Last 2 years, this is when this started. And like I had explained before, and let me clarify that, the DSCR loan specifically is this. The loan is based 100% on your credit score and how much the current or future lease of the property is. In theory, it has to cover 100% of what your future or your current or new loan payment is going to be on this house, including principal, interest, taxes, insurance. If there's HOAs, that includes that too. Now, here's the thing. If the potential leases or the future leases aren't going to cover this amount, we can still do the loan. But, and here's the but, it comes with an additional typically 1/4 or 1/2 point cost to your interest rate. So we will do it with a higher interest rate, okay? So you as a consumer have to think about your credit score and what is the potential lease on this property, okay? You do have to own another property with this type of loan. Again, we're not going to check any of your income documentation. We're not going to ask for tax returns, not going to ask for pay stubs, not going to ask for W-2s. We're not going to ask for any of that stuff, okay? To purchase a single unit with this type of loan, you need 20% down, just like a Fannie Freddie type of loan. This product, I can do a lot more units with this type of a product. So this product, I can go up to 8 units with as much as 30% down. This product I can also do in almost every single state the Americas touch. So I can do this everywhere, not just California. Again, a great product, and it's specifically designed for investors. This product is a great product for people who have a lot of houses, because again, we're not going to check any of their income documentations, tax returns, none of that stuff. A lot of times people who own a lot of properties are cash poor on paper, cash rich in equity, okay? These products, all of these products, these DSCR types of loans, they all come with a prepayment penalty, okay? The prepayment penalty is 1 to 3 years. Higher the prepayment penalty, lower the interest rate, and vice versa, okay? You can buy out the prepayment penalty to have it at 0. To buy out each single year is a cost between 0.25 and a 1/2 point, either to rate or to cost. And so you guys do have that option essentially to have no prepayment penalty on this. Now, what is a prepayment penalty and what the hell does that mean? Prepayment penalties are something very old. In the old days, we used to have these on loans going from maybe 2004 to 2006. A lot of the loans we were doing that time had an automatic prepayment penalty on them. Nowadays, part of one of those lending laws I talked about that passed many years ago is you as a consumer are not technically allowed to have a prepayment penalty on a primary house that you live in and own. This is an investment property, a little bit different. These can have prepayment penalties on them, okay? What a prepayment penalty is, let's use 1 year for an example. If you have a 1-year prepayment penalty and you decide to sell your property after 6 months, the lender, when they submit their payoff demand to the title company, when it's requested, they will submit that you owe them the principal balance, and they will add an additional 6 months of interest to you. Because you had a 1-year prepay and you're jumping ship after 6 months. They will prorate the years that the amount of time you've been in it, and then they will come back and they will charge you 6 additional months of interest on top of your payoff. That's what prepayment penalties are. So I highly encourage you guys, when you have loans or you're looking at things with the prepayment penalty, you got to think a little bit more long term here, because obviously this thing is going to be it's going to be the albatross here for a few minutes attached to this property. Okay. This product is a really great product, and it's a great product again because of the minimal amount of documentation it requires from someone. Now, with this product specifically, and I will give you guys some examples when I go through some of these other products, this product specifically, I have a couple of things that I can add to it to keep the payment lower. So I gave you guys the average interest rate on a 30-year fix with Fannie Mae investment purchase today is 6.99. The average interest rate on one of these products today is 7.375. Okay, it is a higher rate. I recognize that because the risk factor is higher. Now, The things I can do on a DSCR type of loan is I can put it in a 40-year term versus a 30-year, and I can also put it in an interest-only payment. So let me give you an example on what that does to you guys as far as your payment's concerned. If you did a Fannie Mae purchase, I just did an example, $550,000, you put your 20% down. If you did a Fannie Mae loan, I'm only going to touch principal and interest with the payment. I'm not going to add taxes and insurance here, okay? So if you did a Fannie Mae loan at 6.99% today, you put your 20% down, your monthly payment on that mortgage would be $29.24 a month, principal and interest, $2,924 a month, okay? If I put it into one of these DSCR loans and I put it into a 40-year term with interest only at 7.375, that monthly payment today is $2,704. The monthly payment I gave you at Fannie Mae was $29.24. The monthly payment I gave you at this one was $27.04. Okay, so it's $220 less a month with this product. Yes, I know the rate is higher, but again, remember what I showed you: 40-year term, interest only. So again, I have a lot of different ways where I can help shrink that monthly payment considerably based on the product that I'm utilizing for you guys. Okay, so I just wanted to touch on that. All right, user error, advancing screen. All right, next thing we're going to talk about is bank statement loans. This has been a really, really popular product. Bank statement loans came into our industry about 4 years ago, so they've been around for a minute. They've gotten a lot more, what's the word I'm looking for? They've gotten a lot more aggressive in what they'll allow you guys to do as a consumer. So a bank statement loan, the number one thing, if you want to use a bank statement loan, you have to be self-employed. That is the number one thing. And this is the reason why. We're using the bank statements to calculate alternative ways of income. And so what we're going to do with bank statement loans is we can use 12 or 24 months of either personal or business bank statements. We're going to add all the deposits from those 12 or 24 months, and then we're going to divide it by that amount of months. That is how we calculate your income for this type of a loan. So people who are in the service industry, who have a lot of cash heavy deposits, they are primed for these types of loans. These are great products for them. And again, this is a loan. It's a 30-year fixed loan. It's nothing. These aren't ARMs or anything like that. These are 30-year fixed loans, regular kinds of loans. They just have a different way of essentially verifying the income. These type of loan, this bank statement loan, is called a non-QM loan. So remember when I talked about Fannie Freddie, QM loan, qualified mortgage? This type of loan, bank statement loan, is a non-QM, so non-qualified mortgage. Specifically because we're using alternative ways to validate your income that you have the ability to pay for the loan, okay? The minimum FICO score for this type of a loan is a 640 FICO score with a 20% down payment. And this is where it gets a little bit sweeter on these things. You cannot have a foreclosure, BK, or short sale only in the last 24 months. Remember Fannie Freddie, if you had a foreclosure, you got to wait 7 years. With these products, you only got to wait 2 years, okay? Again, this helps you get your foot in the door sooner than later. Now, this is a question I get asked a lot on this. Can I use different bank accounts? The answer is no, okay? So whatever the 12 or 24 months I'm going to look at, whether it's business or personal, it can only be one single account. I cannot use multiple accounts and add them all up in those kinds of months. It doesn't work like that, okay? So again, if you're a business owner and you got 5 business accounts, I would ask you which one has the most deposits, and that's the one we'd work backward on to figure out what your income is and what you qualify to purchase with that type of income, okay? Again, you must be self-employed with this product. The reason is because we're using your bank statements to validate your income coming in for your self-employed business, okay? Now, as far as being self-employed, how are we going to verify that? Well, we're going to do a couple things. We're going to ask you if you have a website. Maybe we'll ask you if you filed a Schedule C on your taxes. Maybe you have a business license. Maybe your type of industry requires you to have another type of license in itself. Like I'm a loan officer, I'm required to have what's called an NMLS license. So I could simply show my license that would deem me self-employed. So this bank statement loan product can also be a hybrid and put in place with another one. So if you have a wife who has a full-time job and gets a W-2 and has taxes, and then you have a husband who's self-employed who gets bank statements, I can use both of their income in a separate way and combine them together. So I could use a bank statement loan on one client, a regular verifiable income on the other client, and I can combine their incomes together. So both clients do not have to be one or the other. Both clients do not have to be the same. They can be one or the other, and they can still work together on the same loan for the same purchase, okay? All right, let's get to the next one here. All right, Asset Optimizer. This is a new product, and this one's come out probably in the last 6 months. This is a very unique product, guys. Specifically, again, this one that I'm going through is designed for an investment purchase. This is for someone who theoretically is sitting on a lot of cash. Now, obviously, that's not me, and probably not some of us on this phone, but there are a lot of people sitting on a lot of equity right now. A lot of that equity is coming from baby boomers. There is a statistic that shows us that over 80% of retirement wealth in the last 2 years is coming specifically from real estate. Okay. This asset optimizer, what this does, you have to have a 660 FICO score. Again, no foreclosures, BKs, or short sales in the last 24 months. I can go up 50% debt to income ratio on this. This is how the loan works. This loan specifically requires you to have 110% of the loan amount you're inquiring about. So if you want a loan of me for $500,000, you have to show me that you have in the bank $550,000 plus 6 months reserves of the potential purchase we're doing. Okay, we can go up to 80% with this with a 720 FICO score. This is specifically just based on your assets that you have under your belt or in your account. That is it. Okay, and obviously your credit score. So this is for someone who's sitting on a lot of cash, who maybe hasn't worked for a long time, has no income, but again has heavy assets. Now, how do we verify assets? Well, there's a few different ways. We can use retirement. When we go and look at retirement, we can use 75% of whatever is available in your retirement. Okay. We can use life insurance policies. Obviously, cash in the bank is easy to use. We cannot use equity in a house. So if you tell me you only owe $100,000 on your house and it's worth $1 million, so in your mind you got $900,000 in equity, unfortunately, we can't use that for this type of a loan to verify that as an asset because it's not liquidable at the time. Okay. Again, great product, Asset Optimizer, pretty new product, only been around this year. Private money. Okay, so I've been doing loans for quite some time. I started doing a lot of private money loans from 2004 forward. I started doing a lot of private money loans. So I'm very versed in private money loans. Private money, typically when you hear that term, you think of this. You think of interest rates in the 15% range, 5 points. Let me tell you this. I've been doing private money for a very long time. I have a very, very healthy network of individuals and companies who will lend private money. I typically can go with as little as 30% down. We do not check FICO scores. We do not check any income documentations. I have multiple private money people that do not require an appraisal. Okay. If you own other properties or you own land or something that has equity in it, like let's say that guy who has the $100,000 mortgage or $100,000 debt, $900,000 in equity, I could utilize that equity to cross collateralize that as his down payment to buy another property. Okay, what does that mean? That means the property you're purchasing, we're going to cross collateralize it against the house you own, so we're going to attach the two together. Okay, so if you need $500,000 of equity out of this house to put for your down over here, we're going to tie a $500,000 lien to this property and use it as a down payment on this one for you. So I can get real creative on private money stuff, guys. Private money loans I can close in as quick as 7 days, typically 5 business days. If I start on Monday, I can typically close by Friday. I can close really, really fast with private money. The average interest rate right now with private money is 9.99% interest only. Remember, I gave you 6.99% fully amortized. So 9.9% is an interest only payment. Typically points on that hard money, we typically start at 1 point and it can go up from there. 1 to 3 points is pretty average what we charge for private money loans, depending on the loan size. Larger the size, less the points. Lower the size, larger the points. Okay, pretty simple. Private money loans, if you're trying to win an offer and you're going up against 10 other people on there, private money loan will get you through there pretty quickly. Now, private money loans, most of the private money loans I do not have prepayment penalties on them, meaning that you could use a private money loan to get or win that investment property and then come back to me in a couple months and I can refinance you into a regular Fannie Freddie type of loan. Okay, so again, get your foot in the door, save the deal, come back, put a regular loan on it. Okay. Let's see here. All right, I got a couple examples here. Now, I have a couple of different examples. So I put an example up here for a refinance and then one for an investment. So the first one is an investment refinance. This gentleman, I did that DSCR loan that I was talking about. This house was a very unique house. It was in Sacramento. It was 3 units, and he wanted to get cash out of it. This guy bought this property, I think he bought it about 6 years ago. He got it at an auction, so he got it for a very, very small amount. Now, what this and let me tell you this client I'm talking about. This client is a very sophisticated client. First of all, this client owns over 30 properties right now, and he owns the majority of those free and clear. So this guy has really been able to leverage investment properties through the years and be able to leverage it to buy more investment properties, which is what he's doing with this. And so what he's doing on this loan, it was a DSCR loan. He had to show me all his rental income on the property. So that property right now is renting for a little bit over $4,000 a month for all 3 of the units. Okay. And he wanted cash out. So the amount of cash out I was able to give him was $375,000 cash out. Okay. His monthly payment on the property obviously went up. His leases right now are covering the monthly payment by over $800 a month. So he has a positive cash flow, and he just got $375,000 for cash. What do you think that guy's going to go do with that cash right now? You're dang right. He's going to go buy more investment properties. Because the market has turned to a buyer's market right now, there's a lot of people who want to move inventory right now who aren't sitting around waiting for multiple offers. They're taking the first one in. And so there are a lot of opportunities for investment purchases at the moment right now. Okay. So this is an example of someone who did a cash out with that DSCR product. The interest rate was 6.75%. It was a 40-year term. It was interest only. Second example, this one closed last month. This was a Fannie Mae investment purchase, $560,000 purchase price. The gentleman put 20% down. 30-year fixed interest rate was 6.125. His property is cash flowing about $255 positive a month. So this is a good purchase for him. It was a standard, again, Fannie Freddie type of loan. All right, so I'm coming to the end, guys, and I wanted to share a couple things here with you guys. Let me see here, make sure I do this right. So in the chat box, I am going to put that didn't necessarily come out how I wanted it to. So in the chat box there, I have some different links available to you guys. I will email you guys some of this stuff. And the thing I wanted to finish with this was this. So I've been doing loans for a very long time. Over 20 years now I've been in this business, and we are in a very unique market right now, I'll be honest. I've never seen anything like this. I don't think hardly anyone has, where interest rates continue to go up. Housing prices have cooled down a little bit, but we don't necessarily see any kind of dip we don't see anything. We don't see a bubble. We don't see anything bursting right now. And so I think there's going to be a lot of opportunities for investment purchases as we turn the corner here in the next year, specifically this year and next year. Sellers are very anxious to move product right now or move their inventory. And so again, they're waiting for buyers to show up with their hand raised telling you, I want to purchase that property. And so I'm a broker, and I am licensed in California and some other states, but specifically California. And being a broker is this. When you guys go, let's say you go to In-N-Out. In-N-Out has a very select menu, okay? Let's say they have 10 items on their menu. Or you go to Jack in the Box. Jack in the Box has 110 items on the menu. At Jack in the Box, you get more options. Well, I'm a broker, so I'm Jack in the Box, okay? Right now, in the state of California right now, I'm licensed with 144 banks. I'm licensed with Chase, Wells Fargo, Golden One, schools. I'm licensed with all those banks, but I'm also licensed with a lot of other banks who allow me to do a lot of other types of loans, like these non-QM loans, rehab loans, flip loans, things of that nature. Okay, I didn't talk about flip loans today because that it really isn't necessarily the market that's coming onto this call. If you have any questions about flip loans, I can do flip loans. That's just a very different conversation that we'd be having for that. So I really appreciate you guys coming to my webinar today. Again, we will email you guys a follow-up to any of those who attended today, and we email you guys the slides. So the next step for you guys is essentially helping you guys get pre-approved so you guys can get out there and start shopping. Please go on my website to loandude.com. I will also send you guys all the links here if you want to schedule something with me on my Calendly link. And if you guys go to my website, there's a button in the upper right-hand corner at loandude.com that just says apply now. If you're interested in applying now and seeing what you qualify for an investment purchase, please go ahead and do that. I will recognize your name if you were at the seminar today. I can't see that name in there. So again, I thank you guys very much for attending our webinar. We wish you guys peace and health, and have a great weekend. Thanks, guys.